Can summer fun for families mean summer dollars for home gamers? These topsy-turvy stocks offer thrills and chills. But in the stock market, the only right direction is up. Six Flags, Cedar Fair. Which ride can take investors to the most exciting heights?
What can you do if you don't trust this topsy-turvy market? Sure, the last couple of trading days have been terrific, but the average is a bad habit of turning on us just when it seems like we may be out of the woods. So for those of you who are still feeling nervous about a potential slowdown, I can't blame you. Let me tell you how to protect yourself. You want yield, bountiful yield. In an environment where Treasury yields are still at ridiculously low levels, 10 years around 1.6%, the 30 years barely above 2%, stocks with big dividends become a lot more attractive. There's no competition from the bond market. If you want investments that generate income, dividend stocks are the only game in town. Unfortunately, everybody else knows that too. Most of our go-to high yielders have been performing pretty well of late. And when dividend stocks go up, their yields shrink. That's why we're on the hunt for new options. We want stocks that are somewhat down and out, giving them accidentally high yields. I call them AHYs, but not so down and out that these juicy payouts are in danger. In short, you want something like the amusement park stocks, Cedar Fair, and Six Flags. With Labor Day weekend rapidly approaching, sadly, it might seem like a weird time to highlight a group that does so much of the business during the summer, but hear me out. Cedar Fair and Six Flags were both excellent long-term performers. They've made you a lot of money over the past decade. However, in the past year or two, both stocks have peaked and come down substantially from their highs. That's how you end up in a situation where Cedar Fair sports a 7.1% yield, and Six Flags has a 5.7% yield. Talk about flags. This is a red flag, right? Some of it's because these two companies have always paid generous dividends, but some of it comes down to the recent underperformance in the companies and therefore their stocks. I think those dividends are both safe. But because we believe in diversification, you should really only consider owning one amusement park stock. So the question is, which one? Let me show you how you choose between two very similar stocks. It's a tutorial. Don't worry, I'll make it fun. Cedar Fair owns 11 amusement parks, along with 3 water parks and 4 hotels, all of them in the U.S. Six Flags is bigger. They're the largest theme park operator on Earth, with 25 parks, mostly in the U.S., although they got a couple in Mexico, 1 in Canada. There's not a lot of daylight between them. Now, why have these two stocks fallen out of favor with the Wall Street fashion show? Their stories are a little different. Cedar Fair peaked in May of 2017 and spent the next 2 years moving steadily lower before the stock finally bottomed roughly 2 months ago. The culprit? At first, when the company started reporting disappointing numbers in 2017, the company blamed the weather. The analysts believed them. Heading into 2018, Cedar Fair rolled out new roller coasters at its 2 largest parks. There was a lot of optimism. It typically means that there's going to be a boost in attendance. But then the company pre-announced some dismal numbers in July of last year. Once again, they blamed the weather, although this time investors didn't buy it. Since then, Cedar Fair has struggled to regain Wall Street's trust. And even though the last few quarters were solid, they didn't prevent the stock from rolling over along with the rest of the market in May. So Cedar Fair's had an attendance problem. So what about Six Flags? This one kept climbing until 14 months ago, then spent the next 9 months getting just completely and unmercifully hammered, losing 36% of its value by the time it bottomed in March. Since then, the stock has shown some signs of life, but it's still well off its highs. And the story here is pretty much the same, just on a compressed timeline. Six Flags started seeing weaker results. They blamed the weather. And just so the company got a pass, right up until they reported a very weak quarter last October, right into the teeth of the market-wide meltdown. There's one more component here. Six Flags has been looking to license its brand and allow foreign developers to create franchises overseas. Hey, that could give a nice revenue stream, right? The company had big plans, including parks in Dubai, Saudi Arabia, and China. But those projects got delayed, and some of them may not even happen, which crushed the stock. Still, just like Cedar Fair, the last couple of quarters have been better than expected, but no one's paying attention except for us. And just like Cedar Fair, it didn't really matter when the market sold off in May, although Six Flags has been bouncing. Now that you know where each of these companies is coming from, we got to figure out which is better in a clinical and rational way. Six Flags has roughly twice as many properties as Cedar Fair. However, the revenues are almost equal. $1.5 billion for Six Flags, $1.4 billion for Cedar Fair over the past 12 months. Still, Six Flags wrings a lot more profit out of those sales, $275 million versus $170 million for Cedar Flags. Point to Six Flags for Cedar Fair. Point to Six Flags. Actually, a very big point to Six Flags. How about the quality of their parks? Six Flags has more of them, and quantity has a quality of its own. Six Flags also has a branding relationship with Warner Brothers, which helps. On the other hand, Cedar Fair's flagship properties in Ohio and California are probably the best in the business. Plus, Six Flags has some international exposure, which is not right what we want right now when it feels like the U.S. is the last economy standing. Most importantly, there are the numbers. In the last month, both companies have reported solid quarters, which is the only reason I'm comfortable recommending them in the first place. I wouldn't be doing this piece otherwise. Six Flags delivered some mixed numbers, small earnings miss coupled with a modest revenue beat. When you drill down, though, boy, there's a lot to like, including an 8% increase in attendance. That's stellar. And they're starting to make money on their international licensing deals, including that project in China. As for Cedar Fair, the results were unambiguously strong. A gigantic 25-cent earnings beat off of an 86-cent basis, with higher-than-expected revenues thanks to an upswing in attendance. They sold a record number of season passes, and their in-park per capita spending, which is something we like so much about Disney, keeps climbing. On the conference call, CEO Richard Zimmerman said, "We feel very good about how the year is tracking as we move into the month of August, followed by the increasingly important and very popular Halloween and winter holiday events." Boy, do I ever like the fact that these guys are no longer just one season. So what changed here? Maybe Cedar Fair's execution improved. Maybe the problem really was the weather. When you're a theme park operator, that does the bulk of business during the summer. Weather can be make or break. Hey, listen. Rainy weekends just crush you. Either way, after the last quarter, we're crowning Cedar Fair as the winner. It's in a better position than Six Flags, although, of course, we welcome both on to tell their story. And you know what's crazy? Cedar Fair also has the cheaper stock. It sells for less than 15 times next year's earnings estimates. Six Flags sells for 19 times earnings. That's a substantial discount. It shouldn't be happening, especially when you consider that Cedar Fair pays a bigger dividend. It's got a 7.1% yield versus 5.7% for Six Flags. Oh, and Cedar Fair's payout is safer, too. It eats up 58% of their operating cash flow compared to 68% for Six Flags. These stocks, well, Cedar Fair is mispriced, I think. The bottom line, if you're searching for income, look no further than the amusement parks. They're a natural place to go. But if you're going to choose one of these, it should be the cheaper, higher-yielding Cedar Fair. Symbol fun, which I believe is right now a better bet than Six Flags. Let's go to Daniel in my home state of New Jersey. Daniel!
Hey, Jim. First time, long time.
First time, long time.
So me and my buddy, I'm new into the market, and we've been discussing Royal Caribbean. And I wanted to know your opinion on it. You know, it's at a little low right now, and I wanted to know if it's still a good buy at this number.
I think Richard Fain is a terrific operator. I like Royal Caribbean. I mean, some of these stocks, they're just short-term blips. I think that that's a very good one to go with. And I believe you and your bud, first time, long time, are doing the exact right thing, buying some RCL. All right, let's understand each other. The market's been a wild ride. But if you're looking for a play that can help you stomach it, I say no. I think the amusement parks are the place to go. There's much more mad money in it. You may not know it by looking at me, but you don't have to be sexy to make money. Tonight's charts may not have the looks, but they got the staying power. I'll reveal the names when I tackle the technicals. Then the state of the consumer has never been more robust. I'm talking about the consumer here. I'm going to reveal why. And all your calls, rapid fire, tonight's edition of the Lightning Round. So stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.